Okay, this morning, what we are going to be looking at is operational risk within the context of the Basel Accord. I use the word Basel very carefully because we have, the various accords starting from the Basel I Accord to Basel II, Basel III. We now have Basel III Accord. We're going to be talking about operational risk within the context of the Basel Accords. Now, let's just quickly remember that the Basel itself is the name of a city in Switzerland. You can either pronounce it as Basel or Basel, whichever is correct. Because in that city in Switzerland, you have both Germans and the French. And so, if you're a German, if you're a French, the pronunciations are different. But truly and truly, we're talking about the name of a city in Switzerland. And it is in this city called Basel that you have the Basel Committee on Banking Supervision, where they have their office there, situated in the International Bank for Settlement. And so when we say Basel Accord, we are talking of the name of a city where these decisions and recommendations were made by the Basel Committee on Banking Supervision. So what we seek to do this morning is to try to have a very simple understanding of what all of these accords are, and then of course to tail into a discussion of the operational risk management concept. Now, the Basel Accord started from 1988. Prior to 1988, there was no Basel Accord. But by 1988, the group of G10 countries, the most industrialized countries of the world, came together that there was need for international standard in terms of the definition of capital standards for various banks. And so in 1988, there was the need to define capital adequacy ratio for banks as the ratio of your capital to risk-weighted assets. And the risk-weighted asset then means credit risk, essentially. But however, that definition was too broad. There were challenges with the Basel I Accord because it was unable to address adequately the challenges which banks were facing at the time. And so, at some point, it was necessary to bring in the risk that arises from banks, trading on their risk assets. In other words, taking some of their credit risk exposures, from on balance sheet, from on balance sheet to off balance sheet, and to be able to capture, the risk that follows from that, became necessary for the committee to say that yes, you now have to include market risk in the definition or the calculation of the capital adequacy ratio. However, despite the good intention, that did not stop banks from failing. And so operational risk now became an issue, especially with the collapse of the Barings Bank in UK. It became an issue, and so the Basel Accord had to expand the scope and space of the definition and the characterization of the Basel Accords. And so by 1996, 95, operational risk was brought into the denominator in the computation of the capital adequacy ratio for banks. But that's not the real issue here. The real issue is that the accord was defined more broadly to cover what is now called the three pillars of the accord. And the three pillars are: the first pillar is what they refer to as the minimum capital requirements. And then of course pillar 2 has to do with the supervisory review process, and then pillar 3 was the one they refer to as market discipline. We'll try to explain what all of this means. We don't want to go into technicalities at this stage, but the point is, the Basel Accord had to move from simple definition of capital adequacy ratio to cover more broadly, the more serious hard issues that makes bank to fail in terms of supervisory review process and etc. Now, what are we trying to say here? We're trying to say, let's now look at the pillar 1, which is the minimum capital requirement definition for banks. Because as we know, capital serves as a cushion against unexpected loss. It's a cushion. And when you are trying to define that cushion, they moved away from simply using credit risk as a basis for the definition, and then of course gradually to market risk, and of course to to operational risk in terms of the definition of the capital adequacy ratio. And let's try to understand what we are trying to say. The capital adequacy ratio, the ratio of your capital to your risk-weighted assets. Now, what is credit risk? What is market risk? And what is operational risk? Of course, we all do know that credit risk is the probability or possibility that an obligor will fail to honor obligation when it falls due. And for as long as that possibility is there, Basel is saying you must provide capital to take care of that, to serve as a cushion against unexpected loss. Market risk, on the other hand, has to do with the possibility that as a result of changes in fundamental relating to price fundamentals, that your portfolio, you could suffer huge losses from your trading portfolio, and we're going to explain in detail later on. But of course, operational risk, by definition of the Basel Accord, is also the possibility that a company or a bank could suffer losses as a result of inadequacies or failures in its systems, processes, and of course external events, including IT-related issues. Operational risk, by definition of the Basel Accord, is the risk of loss that could result from failed or inadequate internal process, people, and systems, or from external events. And that this definition includes legal risk, but excludes reputational and strategic risk. All of that I'm going to explain. So the point we have so far made is that under the Basel II Capital Accord, it went beyond the issue of just capital definition, but it went ahead to include 3 pillars: Pillar 1, Pillar 2, Pillar 3. Pillar 1 deals with the minimum capital requirements. Pillar 2 deals with the supervisory review process. Supervisory here we mean your regulators. So in this case, as in the case of Nigeria, we're talking about the Central Bank of Nigeria. So this regulator will be the one to be reviewing. Reviewing what? Reviewing what banks have done under Pillar 1. And of course, you have the third one, which is the minimum reporting requirements, minimum disclosure requirements, that is referred to as market discipline. So the whole accord is sitting on these 3 pillars. So this one is more robust, more comprehensive than what we had under the Basel I Capital Accord. Now, for you to be able to calculate the amount of capital that you're going to set aside for each of these 3 buckets of risk, that is credit risk, market risk, and operational risk, Basel has defined very stringent formula, very stringent principles and guidelines for each bank to follow in the implementation of the Basel Accord. So let's take credit risk for instance. How are you going to define the amount of capital to be set aside for credit risk under the Basel Accord? Basel has come up with 3 approaches. The first approach is what they refer to as a standardized approach. The second one is the foundation internal ratings based approach. And then the final one is the advanced internal ratings based approach. Now, in discussing the standardized approach, what Basel is saying is that each bank has to appoint an independent rating agency. Basel is saying that each bank will have to appoint a rating agency to do what? To rate your obligors. So if, for instance, the Nigerian Export-Import Bank has about, let's say 400 customers, credit, customers. Basel is saying you will appoint a rating agency to rate your obligors and assign ratings to each of these, your customers. It is on the basis of that rating that the bank will now be able to define or calculate the amount of capital to be set aside for credit risk related issues. Now, from that approach, you move to a more sophisticated approach, which I have just referred to, the Foundation Internal Ratings Based Approach, which is also called FIRB. Now, for that approach, there are 4 parameters that we need to take into account. The first is your loss given default, your probability of default, your exposure at default, and then of course what is called granularity, which addresses the issue of diversification in your portfolio. Now, so if you take customer A for instance, you have to calculate the probability of default, the probability that that obligor, what is the probability that he's going to default when he borrows money from the bank. That estimate has to be calculated. Okay? Then from there you move to the loss given default, the loss that you are going to suffer given that the customer has defaulted. Then you have the exposure default. What is the total exposure of the bank at the time of default of the customer? Then of course granularity, which measures the diversification of that portfolio. Now, because this is a foundation approach, Basel is saying that the bank is only expected to provide estimate for the probability of default. For the other 3 parameters, your loss given default, your exposure at default, and granularity, all of that will be provided by your regulator. In other words, you cannot implement a foundation IRB unless the regulator is ready to provide you the estimate for the other 3 parameters. From there you move to the advanced, and it's truly advanced. If you want to implement an advanced internal ratings based approach, then that bank or financial institution must provide estimates for all the 4 parameters. So that all that I have just described is how you define the amount of capital charge for credit risk. Remember, in the denominator of the calculation of the capital adequacy ratio, you must provide capital charge for the 3 material risk areas: credit risk, market risk, and operational risk. In summary, what I have attempted to do here is to provide us an overview of what Basel Accord is all about. And we have said that there are basically the fact that the Accord is resting on 3 pillars. For the first pillar, which I've been describing, that is the minimum capital requirements. You have to be able to define estimates for 3 risk areas or risk buckets: market risk, operational risk, and credit risk. We have focused on credit risk, and what I have said in essence is that there are 3 approaches for calculating the amount of capital for credit risk, and I'm sure that is very simple enough. And so in the next presentation, we are going to be focusing on how to calculate the capital charge for operational risk. Then from there we move to market risk. Thank you very much.